I think the goal here is to really understand the risk. It's not to scare anybody, but it's to make sure people understand the reality that when you have a climate crisis and you have more extreme weather events and you have increase in sea level rise, we have to understand what its impact is and plan ahead so that we can avoid a crisis when it comes to the financial piece. We obviously have to address the climate piece, and the chairman and I and others have been working on that, but we do need to understand what's happening here. So in Dr. Keyes, in recent weeks we have seen a number of very high-profile bank failures. I understand fully that the insurance markets are regulated differently, but they still need to be adequately capitalized. So do you perceive a risk today with respect to insurance companies being prepared as a matter of capital to deal with the ongoing risks from climate change?
Well, thank you for the question, Senator. I think others on the panel may have more expertise on this than I do, given that they manage a balance sheet more directly. But I think this is an absolute cause for concern. And when we look at the failures of insurers in Florida and decisions to pull out of Florida in particular, I think that speaks to some of these concerns directly, and that there are worries that they don't have the balance sheets directly and that they can't obtain sufficient reinsurance to protect themselves, that they're leaving risky markets. And so one of the explanations for the shift in their choice of which markets to insure and which to not insure is in part a function of their balance sheet.
Well, let me pose the same question to Mr. Anderson, and picking up on what Dr. Keyes just said, right? There are two ways that insurance companies could respond if they wanted to address the risk. One is to increase rates, and that's true also in the reinsurance market, and that obviously increases rates for consumers. Or they can decide just to pull out of insurance markets in certain areas, like parts of Florida. Can you talk about what we're seeing right now and its impact on consumers?
Sure. I mean, the crisis of confidence that's happening in the reinsurance market that's leading into the insurance market is essentially a crisis of confidence around the ability to predict loss, which is kind of your question around, is climate changing the confidence level that these insurers and reinsurers have around providing products to consumers or businesses? And the short answer is the reinsurers today have been withdrawing from high-risk areas around wildfire, around flood in particular. Some of the other natural catastrophes like earthquake, less susceptible to this topic, and so not as much dynamic change. And so the question of, is there enough capital to handle the transition today? The answer is no. The effect of how do you create more capital is better transparency around predicted losses. That's where a lot of the work in the industry is going today, because private capital will not join the market unless they expect a return, and they will not be able to expect a return if they don't know the risk they're taking. And so the answer to that is they essentially trim their offerings. They pull out of high-risk areas. They drop certain products. They get out of certain states. This is happening, by the way, around the world. It's not just a U.S. issue. But the underlying facts of the decision-making are the same, which is they don't understand the risk they're taking, and therefore they won't take them.
Right, and Ms. Watkins, just to follow up on this conversation, it seems that there are actually three possibilities here. One is that we don't do enough in advance, and you have a meltdown in the ability of insurance companies to make coverage, or you increase price, and obviously that means consumers are paying more, or insurance companies pull out entirely, as we're seeing in Florida and other places. Or when insurance companies pull out entirely, it's the taxpayer that ends up picking up the bill. Isn't that right?
That's exactly right, Senator.
I mean, those are the options. Can you talk a little bit about what's going to happen to homeowners in coastal communities? It seems to me there are really just two options for folks who are don't have any more coverage. One is that they're on their own and they have huge risks, and their nest egg, it just goes under, or the public sector provides a bailout. Are those the the two options there?
As of right now, yes, sir, I do believe those are the options. And so, I mean, we do have federal disaster aid, which will come in and if there is like an event that creates a loss and they have no insurance, that would help them somewhat, but it won't really restore them to a resilient position for the home. I think that to get in front of that and to try to give people better information when they're making the decision to live in a place, having the insurance risk signal would help avert both of the situations that you mentioned.
Thank you. Well, we see what happens when people don't get in front of a banking situation. The same would hold true when it comes to the insurance market. Thank you, Mr. Chairman.